Well, I think now the market's kind of moving to this tariff issue, and I think it's kind of discounting maybe some positive news coming out of it. I don't know why, because I think we still don't know what's going to happen. Everything we're getting indications to say they're not really that close, but earnings are coming through. You've got some solid companies coming, except for Intel, and people are saying things aren't that bad. So I think you got a question of maybe we got oversold in December, which we think we did, but things aren't really that bad, and valuations have really come down. You're at 15 times earnings compared to 18 at the beginning of last year, and certain sectors like financials have really been punished, so you've got some kind of basis as to where we can go from.
David, things may not be that bad, but they don't appear to be all that great either. It's not like earnings are gangbusters.
No, but the fact that they're not deteriorating is really what is important. And what we're looking at is a situation where you have a slowdown that's taking place, but not something where there's an imminent recession. And I think there's a lot of fear that's been digested, in the last, really since last October, and that markets now seem pretty normal. Think about what happened this week. Everything that came out of Davos sounded pretty negative, and
as usual,
as usual, great. But even with an amplifier.
Well, a year ago, everyone was really happy about the world. So I don't know if it's always that way.
Right. Yeah. So but what I'm saying is, you take a look at the week, and you have news on China, you have the news, political news today, you have what's going on in Davos, and then the markets ended up closing well, even in China, all across the globe.
I wonder, though, if we can kind of set as a premise that December was this very intense kind of overshoot to the downside because of not just the fears of a big slowdown, but liquidations of hedge funds, a lot of extraneous things as well. If we say for now that's the low, what's the ceiling? Because I wonder about exactly how much the market is going to try to put a bigger valuation on earnings that are still eroding for 2019. So that's a big question.
Right. I'm not sure that earnings are eroding.
Well, the growth rate
is slowing. Right. Exactly.
We're talking about below 4% for the next 3 quarters for the U.S.
Weren't we at 2 points? I mean, aren't we at 2.7% or something like that earnings growth this quarter? I mean, we were.
The revenue growth is actually better.
Yeah, so it's under 4% for the first 3 quarters of this year. That's all. Yeah.
Right. I mean, we were expecting actually higher earnings in general in the U.S. than are currently projected, somewhere between 7 and 8%. And we also think with current valuations being where they are, around 15 times, you can imagine that the market could be 7 or 8% higher from here. Or if you want to look at it differently, we could close at a slightly higher high than we did, we got last year.
Sure.
And I think what's happening with a lot of companies, I mean, you take Stanley Black & Decker, you're really not giving forecasts to what you think is going to happen because you don't know if the tariff's going to be 10% or 25. So say you get I think you just need clarity, right? What is it going to be? And I think at that point,
are they ever going to get it?
and that's why some of these stocks are trading at, single-digit multiples, because you really can't put your arms around it in the short term. But our view is high-quality franchise companies, if you're investing for 3 to 5 years, you're getting an opportunity you really haven't in 5 years. So, but it's a rocky ride. It's volatile. And, month to month, when you're looking at kind of what you own, you really have to have a strong stock.
I just wonder if the other storyline that's developing right now is, guess what? Central banks are not your enemy anymore. They're your friend. Because the ECB is kind of stalled where it was. China overnight making greater efforts. Meanwhile, this Wall Street Journal story this morning saying, guess what? The Fed's balance sheet might settle at a higher level than we thought before. We can see the end of quantitative tightening. We're back in the low and slow, high liquidity world.
And the other side of that is fiscal policy, right? A lot of countries globally are going to look at how do we get our economies jump-started. And fiscal policy is something that really hasn't happened yet. And if you see that, but then the fear that will come is, does that lead to inflation? And then, our Fed will be back in the picture again. So you're going to be in this range bound, and you got to have to stick with what you really want to own.
Do either of you think we retest the lows? David, you first.
I don't think so. I think we're seeing a lot of this, accommodative Fed policy. That was the trigger event. December 19th, bingo. The market was down, almost 10% from there. So with a somewhat of accommodative policy, no, I don't think we test those levels.
Yeah, and I think to your point, so much negative news has come out already in the last week.
You agree?
I do agree. I mean, I think you can have days where you go down 2-3%. Volatility is back. But I don't think we go back to December 24th lows, maybe 5% down and then kind of steady from there.
I do think an interesting question is, not to say there's a particular S&P level where the Fed is going to all of a sudden say, okay, fine, we can get a couple of hikes in there. But there's some financial conditions, if they get a lot looser, when the Fed would be back in the game, right?
Right. I mean, you could imagine that if the China issue completely resolved, which I can't quite imagine it would, but if it did, then then that would be a boost to the market, a pretty big hop, and that plus some good news could make the market go up and make people feel much better. In which case, they would feel more inclined to do that. But we're still talking at the end of the day. Look at the forward curve. They're not thinking that there's going to be any. There could be one. Those kinds of numbers you can tolerate. That the 10-year is less than 280 now. So there's a bit of there's a bit of room now.
But there's still a gap between where the market is and where the Fed is on paper.
Correct.
Yeah.
Right. And we'll see what they do. So we're in that situation when you could be in not an ideal situation, but one where there's just simply not that much tightening, and then you could imagine sort of a long slowdown that could last for a long time without a recession.
To Mike's point, I wonder if the market is a little ahead of itself on this notion that the Fed's just going to sit back now and do nothing.
Yes, and I think you're right on that, because if the things that you just talked about do happen, the Fed is going to say, look, rates are still low. Historically, we still need to raise rates, because when things do get bad, we need to have some ammunition. And right now, they don't really have any ammunition. So when that happens, then we're going to get, we're too early for that. We've got too many things to get resolved: government shutdown, tariffs, earnings. Right now we don't see that, but yes, we will see that coming down, hopefully.
Whether that means the market's ahead of itself or just that it's kind of capped at some level, right? Where you have to think the market would have to be up on a 12-month basis and the VIX would have to be below, let's say, 18 or something before the Fed says, okay, all's well.
But the market so badly wants to believe right now that the Fed has changed its tune, and that if not, has changed its policy and is going to be now on the sidelines until further notice.
Yeah.
And the minute there's any upset to that.
Yeah, Powell could call the market's bluff at some point.
Yeah.